40% in a year. I think that's a pretty good return. For a broad basket of tech stocks, that's getting into massive territory.
It might not be explosive growth, but it is one way to beat the market.
So since the start of the year, it's up roughly 26%, whereas the Nasdaq right now is up around 19%.
Vic Lederman with Chaikin Analytics shares 3 ETFs that can help you beat the market.
If we have a tech wipeout, you don't want to be betting on a huge bounce. But at the same time, these are pretty broad, safe, generally speaking, ETFs that you can put money into.
If you aren't in any ETFs yet, this is one way to make sure your portfolio is balanced. Let's dive in. Today, we are excited to have Vic Lederman with Chaikin Analytics with us. Thank you so much for being here. We are talking about trying to beat the market. That's everyone's goal, right? Everyone always wants to beat the market.
Absolutely.
Easier said than done, though, right?
Definitely. And I'm sure you've heard right now, the phrase, if you're not long, you're wrong. That's definitely true in this market. And it seems like everybody is long tech. But I'm sure you've noticed that a lot of investors, when they hear tech, they think Nasdaq 100, QQQ is the ticker, or the Qs, if you like to say it that way. But that doesn't mean that it's always the best way to act on it.
Yeah, not only the QQQ that people are familiar with, but also picking individual stocks. That's what we talk about on this channel all the time, are which stocks to get into, which AI stocks to get, which are the big winners this week. And sometimes it can be really hard to try and find these individual winners.
Exactly. And that's why people end up choosing these baskets. And it's easy to kind of gravitate towards the largest basket thinking that it's the best, right? Today, I'm going to give you 3 examples of other ETFs that might actually be a better choice if you're trying to make a bet on this massive tech boom that we're seeing right now.
Yes, I'm excited about this list today. It's the 3 ETFs that will help you beat the Nasdaq. So let's get into that first ETF you have today.
Yeah, so the first one is the iShares Expanded Tech Sector ETF, IGM. It's a bit of a mouthful, and this one I think would actually really surprise people because the Nasdaq, or QQQ, has today about 101 stocks in it. And this one has more than 200, I think it's 260 some stocks in it. So you'd think with a broader basket like that, you're going to be diluted, it's not going to be doing as well, and yet the way that these ETFs are constructed matters a lot. And the way that the weightings are arranged inside the ETFs matters a lot. And so it would surprise you to find out that this one's actually beating the Nasdaq right now. So since the start of the year, it's up roughly 26%, whereas the Nasdaq right now is up around 19%. Those are phenomenal returns in any year, but I'd rather have the 26% if I could. And I still know that the names in there are good. If you look at them, the top holdings look very similar to the Nasdaq, but it's that total construction that's helping it get better performance.
Interesting. So this is more names. Are these all still in tech? What sectors do these very long list of stocks cover?
Yeah, this is still a very tech-centric ETF. So they're focused on tech. It's going to be exposing you to those hot AI names. It's going to be helping you find them too. If you've been looking at the list of names in the Nasdaq and you're thinking, I feel like I've seen everything here. Where are people finding these more unusual companies that are really benefiting from the changes going on right now? I would start by looking at this larger list in IGM.
One thing with ETFs, with this one especially, we were talking about so many investors wanting to get really massive returns, and we are seeing some massive returns in the tech sector. What kind of returns can you expect in an ETF like this?
So this is what I would call a good broad starting point. Since the start of the year, we see that it's done better than the market, but it's not dramatically outperforming. And I know that's what people are looking for. But the reality is that there are other ETFs that are dramatically outperforming the market right now, and they're still tech-centric.
Yeah, I think that's the next one that you have for us. We started out with kind of the more conservative tech ETF. Let's get to that second ETF you have for us today.
The next one is the Spider NYSE Technology ETF, XNTK. Another big mouthful of a name there. But this one is dramatically outperforming the market this year.
What does dramatic mean? How much of a return has this one had?
So far this year, XNTK is up 39%. That's getting, for a broad basket of tech stocks into massive territory, 40% in a year. I think that's a pretty good return.
A great return, especially if you're looking at a more conservative approach to the market. It's not 300%, which is what some people have been looking for in many different areas of the market right now. But again, for an ETF, that's a really great return. How come this one is having more returns than the other one we just mentioned?
So in the other one that we mentioned, it was a very broad basket. This one is dramatically more concentrated into a smaller number of stocks.
And which sector are these stocks? What sets these stocks apart?
Yeah, so this one holds is maybe about 40 names, 35, somewhere in that range. So it's a lot smaller than the other two, right? We started with the Nasdaq, a list of 100, and then we went to over 200, and now we're all the way down to, under 40 names or so. And it's going to have names in there like Palantir, Micron, Alibaba, huge Chinese company that a lot of investors still aren't paying attention to, but it's absolutely massive, one of the biggest Chinese blue chips. And so that concentration in these more tech-specific names is specifically the ones that are benefiting from the AI trend. That's where it's getting the juice from.
Well, let's talk about expenses. I know we haven't really touched on that yet with this ETF conversation, but some of these smaller, more specific ETFs tend to be expensive. Is that the case with this one?
Yeah, definitely. So a lot of, different ETFs have different what they call expense ratios. The broadest and biggest ones these days have very low expense ratios. When you look at somebody like Vanguard or Fidelity's ETFs, they can be as low as like 0.02%, which is insignificant, right? It doesn't matter, and you're safe parking a lot of money there over the long run. These smaller ETFs have higher expense ratios. In the case of XNTK, that expense ratio is 0.35%. Now, that doesn't sound like a lot, right? But over a very long period of time, it would add up. So if you were, putting all of your retirement savings in there and parking it for a long time, that would eventually eat away at your returns, and you might consider a broader, lower expense fund. But right now we're talking about trying to capture the incredible momentum that's going on in the market. And those couple tenths of a percentage point, I don't know about you, but I'm not worried about them right now.
It's a good way to get, again, those larger returns that you're looking for. Another interesting ETF. Let's get on to the third ETF you have today.
Yeah, so the last one that I want to tell you about is a bit of an oddball. This is the Spider. It's another sector ETF. It's the Defense and Aerospace, or Aerospace and Defense ETF, XAR. And the reason that I want to mention that is because right now everybody's talking about tech. They're trying to find tech names, and they're, looking for the greatest opportunities. And I want to make sure that people remember that there's a lot of tech that isn't labeled tech, right? We think about a company like Lockheed Martin. That is a high-tech company. Raytheon, also high tech. Like it or not, the defense sector drives a lot of technological advancement. We've seen that with the war in Ukraine, right? The prevalence of drones have absolutely changed everything on the battlefield. Well, the companies that develop those technologies are part of this trend. They're part of the AI boom that we're seeing right now. I mentioned in the previous ETF, Palantir, right? Another big defense contractor. That ETF categorizes them as technology. You'd also be fair to say that they're a defense company.
This sector has been so interesting to look at. I know we've done several videos on this. Our viewers have been very interested in defense stocks, but picking which drone stock to go with, these are smaller companies that have lots of potential. So does this ETF include a lot of smaller names too, or is it largely just some of the bigger names out there in aerospace and defense?
Yeah, definitely. So I would call this a jumping off point. There's, I think, again, roughly 30 to 40 names in this ETF. And you're going to see everything from the heavyweights like Lockheed Martin and Northrop Grumman and, things like that. There's also things like General Dynamics, Huntington International. And, there's a lot of bullish names in there right now. In fact, I believe the last time I checked the power gauge, there were no bearish names inside this ETF. So that's definitely where I'd start, and it'll kind of help you branch out. But the key takeaway there is just to remember that in the market, we're all about categorizing things and trying to put them in these different buckets. But tech is almost everything these days, and there's a lot of innovation going on. And if you're trying to find the best opportunities, don't get stuck just looking at one basket. That's kind of the whole theme of this, right? Some people, they buy the Nasdaq and they think, I'm exposed to the AI boom. That's enough. But you saw with the returns there, it gets better and better and better.
Let's talk about returns for this aerospace and defense ETF. What kind of returns are we seeing so far, and what's the potential for returns in this sector?
Yeah, so you're going to love this. XAR is currently up 46% this year. And like we talked about, that includes some heavyweight names in the industry as well as some of those smaller names. So with the defense one, it's always tough, right? None of us are hoping for war. Like that's not where we want to get the biggest juice in our portfolios. But the reality is AI is changing everything. And war is part of that. These companies are going to continue to benefit from that trend. Uncle Sam is absolutely pumping money into the sector right now. It's incentivizing people to continue to develop technologies in the defense sector. And so I think as long as that tailwind remains true, we could see significant returns going forward.
Yeah, I think there's a lot of potential in this sector for sure. And another really interesting name I do want to share, if you want to look at what the Power Gauge has to say about these ETFs, we have a free way for you to do that. You can scan the QR code right now or click the link right in the description of this video to see what the Power Gauge has to say about all of these ETFs and some of the stocks inside of them too. Vic, let's talk a little bit about how you use the Power Gauge, not just for individual stocks, but also for ETFs.
Yeah, so, we've talked about the stocks inside of the ETFs. And one of the reasons that I love using the Power Gauge to find these opportunities is because we have this thing called the power bar. It's the ratio of bullish to bearish stocks, as well as the neutral stocks in the middle, inside each ETF. And so that allows us to rank ETFs not just by returns, but also by which ones have the most bullish stocks in them. That's how I came up with some of the names that we talked about today.
Very interesting. I think the last thing to talk about with ETFs is knowing how to weight these as an investor. How much of your total portfolio should be on ETFs versus individual stocks? And looking at balancing out some of the riskier ETFs with more of the broad spread ETFs too.
So the names that we talked about today are all pretty reasonable funds to own, as long as the momentum is with you on your side. You don't want to be betting against the market, especially, right? If we have a tech wipeout, you don't want to be betting on a huge bounce. But at the same time, these are pretty broad, safe, generally speaking, ETFs that you can put money into. That said, the way that I tend to think about it is that you have investments and you have speculations, right? And your speculations should always be at a level that allows you to sleep at night. These are the ones that you're hoping for great returns on, but you understand that some of them could go all the way to zero. We're definitely going to see that in this AI boom. There's no getting around it. But in some of the broader names, right, we don't expect the entire defense industry to go to zero. Even if it does face a downturn with a tool like the Power Gauge or whatever you prefer to use, you should be looking at the long-term trend and making sure that momentum is still in your favor and that you're not betting against a changing wind direction.
Well, great conversation today, Vic. Thank you so much for your time. Great to talk to you and so many of the colleagues from Chaikin Analytics while we've been here in Vegas this week.
I really appreciate it.
Yes, let us know what you think in the comments. Are you someone who's looking at ETFs? Is this a way that you'd like to invest in tech and really get some value without having to pick individual stocks? Or do you like to look for those individual winners? I'd love to hear what you think in the comments. Thanks again for watching, everyone. And as always, happy investing.